The broadcast is now starting. All attendees are in listen-only mode.
Hello and welcome to Corporate Energy Procurement Best Practices, Trends, and Strategies. Our webinar today is with Stoel Rives and AVANGRID Renewables in partnership with InfoCast Events. Today I have with me Jason Johns, partner at Stoel Rives, and Barrett Stambler, Vice President of Origination at AVANGRID Renewables. And today, before we get started, if you have any questions, please type your questions in the Q&A box in the lower right-hand corner of your screen, and we'll answer questions if time permits. Thank you guys so much, and now I'd like to welcome Jason Johns.
All right, thank you very much, Catherine. To begin, as these things go, I'll just give you a very brief introduction to the law firm Stoel Rives, for those of you who are not familiar with us. We are located across the country in 10 different offices, and from those offices we have approximately 350 attorneys. About 100 of us work on energy projects, and we've worked on projects around the country, in every state, in fact, and around the world. Next slide, please, Catherine. Okay, so very briefly, today's agenda is I'm going to run through some various deal structures that corporate buyers are using in the renewable energy market, and layer in a few legal considerations that relate to those structures. And then I'm going to turn it over to Barrett Stambler at AVANGRID and let Barrett touch on some more deep commercial considerations. Next slide, please. Okay, so to begin, I think it's good to set some groundwork and talk about where most customers and developers are in the market today. And so just for purposes of simplicity, I'm going to refer to commercial and industrial customers solely as customers and renewable energy developers just as developers. So today in the industry, as most of us experience at our homes and also at our businesses, we have a relationship with a utility, and we purchase power through a utility tariff. And that utility sources its power from third-party power plants or from power plants that the utility itself owns. Next slide. Now, some considerations with respect to that structure. It's tried and true. It's been around for a long time, but it's also a structure that many customers are looking to alter, and that's because customers in this landscape have enacted or set renewable energy goals or certain corporate green goals, and the traditional utility relationship is too rigid in many circumstances to allow them to achieve those goals. And that's in part because as customers of utility, we're taking service through a tariff. Those tariffs are approved by regulators, and you can't vary them on a one-off basis. In some states, we do have the ability for large enough customers to enter into what's called a special utility contract, but those contracts tend to impact rates only, and therefore they fail to accommodate specific customer goals in sourcing renewable power. Next slide, please. So one way that customers are getting access to the renewable energy market are in states where there is what's called direct access. And direct access is the product of legislation that circulated the states roughly 15 years or so ago, and in some states more recently. And what that allowed for is basically retail competition. So third parties can enter into the retail power supply market and compete against local utilities in some circumstances to supply customers with power. In some of these circumstances, utilities were also required to divest ownership of all of their generation, and they simply become distribution companies that provide the conduit for which this retail power market exists and uses. And so retail access or direct access provides a little bit more flexibility for corporate customers because it allows them to utilize competition, and these third-party suppliers need to generate customers to negotiate perhaps more friendly deals and deals that allow them to more closely achieve their green energy goals. Next slide, please. Now, some of the legal considerations with respect to direct access is that it is geographically limited. Not all states have it, and it's complicated because in the states that have it, the rules or the ground rules differ. So in Nevada, for example, the rules are different than they are in California. Now, one of the other difficulties with direct access and in aligning it with a customer's renewable energy goals is that direct access suppliers, these third-party suppliers, they have to operate very much like utilities. It's very difficult for them to tailor one-off deals for each and every customer because it's difficult to run a business that way. So instead, they have to source a power supply or portfolio of resources, and they may be able to bend that portfolio, here or there for a customer's needs, but nevertheless, a customer who's using a third-party supplier is typically dealing with the portfolio that supplier brings to the table. One other issue with direct access is that corporate customers also may want to switch suppliers regularly. And if a customer wants to contract directly with a specific facility, it's difficult to maintain a relationship with a specific facility while the customer is also moving from one direct access provider to another. And then lastly, in states where there is direct access, some of them do impose upon larger customers especially exit fees, and some of these fees can be very substantial in the millions of dollars. And so there can be a cost to leaving utility service and going with a direct access provider. Next slide, please. So a more recent product in the market is what's called a green tariff. And a green tariff is actually a pretty simple mechanism that allows a customer to cause its local utility to buy renewable energy on its behalf. And so there is a pass-through from the developer through the utility and eventually to the customer of energy and the renewable energy credits that customer is seeking to purchase. Next slide, please. So again, like direct access, green tariffs are not universally available. There are only a handful of regulated utilities around the nation that offer a green tariff to their customers, and usually the eligibility criteria tend to be narrow. A green tariff-like program can also exist if your local utility is an electric cooperative or a public utility district, because those types of providers can be freer in offering deals like a green tariff-like program or negotiating one-off transactions for their corporate customers. But again, they are relatively rare. One of the benefits, of course, though, is that a customer does not need to leave its utility. These are relationships that corporations or customers have had with utilities for years or decades or more, and they can maintain those relationships. They are complicated agreements, though, because they do require pass-through of costs from developer to utility to customer. They are three-party negotiations as a result. And they also require typically long-term commitments on behalf of the customer. And then lastly, utilities, of course, don't want to be stuck in many cases with a contract for a renewable project in the absence of a back-to-back deal with the customer. And so therefore, customers are often required to protect a utility in these relationships against the downside of the customer either going away or there being problems with that specific facility. Next slide, please. So another more recent product that's available in the market is what's called community renewables facilities and programs. And what a community renewables program provides It allows for customers of all sizes, both small and large, and of commercial nature, or maybe even residential customers, to participate in a single renewable energy facility. And so in doing so, the customers don't purchase renewable energy directly, but instead they receive a credit from the revenues from that facility against their own retail bill. And that credit is correlated with the amount of subscription that the customer has signed up for in that single facility. Next slide, please. So community renewables is effectively, for those who know these terms, a form of net metering. And it's a form of virtual net metering, and that's because it's multiple customers who are located across utility service territory, taking part in a single facility located elsewhere. And that facility's output and the revenue associated with it is being used as an offset to the customer's retail bills. And so in that way, it's net metering. Now, as I mentioned, these are nascent markets in community renewables so far. I believe Minnesota and Oregon are leading the charge in establishing the regulatory rules that will apply to these types of programs. But again, this is a very immature portion of the industry. Now, some of the benefits with a community renewables project to the customer specifically is that it allows the customer to purchase smaller units of a larger project. So a customer is not required to be the sole off-taker and therefore the basis for financing an entire large facility itself. Instead, they can purchase smaller units, and together customers of all sizes can help to finance a project. One of the other benefits is that these relationships can be shorter term than some more direct relationships in large projects. And so that provides perhaps less risk to the customer in engaging in community renewables. One of the downsides, however, is that in order for a community renewables facility to be built, they of course need to have a minimum level of commitment in order to receive financing. So there can be some amount of runway before one of these projects gets off the ground. Next slide, please. So I'm transitioning from some newer methods of participating in the industry to an older method. And that's for the purchase of unbundled renewable energy credits, or RECs. And this is pretty straightforward. The relationship here is that the developer will sell its power to its local utility or into the market, but it won't sell the RECs associated with that power. And instead, it keeps those RECs, and there's a market, a secondary market for just that product. And customers can purchase those RECs in different regions and kind of correlate them to the customer's own demand. And the price of the RECs will vary on the location. Next slide, please. Now, from a customer's perspective, perhaps one of the downsides of this is that you are not purchasing renewable energy. You're purchasing these credits. And so there is a less PR value associated with that type of transaction. On the upside, however, they tend to be shorter term commitments, and you can easily align the number of credits you purchase with the amount of demand that the customer has at its facilities, either in a single location or perhaps spread across multiple locations in different geographies. And then lastly, the purchase of RECs really has little to do with a power cost savings to the customer itself. It's seen as typically a simple method of trying to achieve a renewable energy goal or mandate. Next slide. Okay, sticking with the older structures. So another method that some customers use to participate in the renewable energy industry is through corporate ownership. This is what, for example, Google did with some of its earlier investments in the industry in wind. And this is not the purchase of physical power. This is simply an investment in a project to allow it enough capital to be built or to be financed. Next slide, please. Now, these are rare for obvious reasons, I think, and that's because it is not a purchase of renewable energy. It's not as a purchase of RECs. It is an investment in a large piece of infrastructure, and as an investment in a piece of infrastructure, it requires a very large upfront capital investment. So there are very few customers who may undertake that risk or see that as something they are interested in. And instead, of course, of receiving power itself or the RECs, the customer would receive revenues associated with the facilities, or if the customer has a sufficient tax appetite, then it would receive, could receive tax credits. Next slide, please. Okay, now transitioning to, again, a more recent form of method that customers use to participate in the market. We have physical deals on the wholesale market. And the structure here is that a developer would sell its power and its RECs to the customer. The customer would then strip off the RECs and use those for its own purposes, for claiming renewable energy benefits. And then separately, it would then resell the power either to its local utility or into the organized energy market where that facility is located. And so that creates some complications. Next slide, please. And the first bullet point is the truest. It's a complicated structure because it exposes customers to a whole new type of regulation that they likely have not encountered before. A customer or any party who is selling power at wholesale, and in this circumstance, it's the customer because they purchased it from the developer and then resold it into the market, that customer is now a wholesale seller of power. And it's acting like what we refer to in the industry as a power marketer. And power marketers and others who sell wholesale power are regulated by the Federal Energy Regulatory Commission, and they are considered, quote, public utilities under federal law. And that comes with a slew of obligations that most customers have not had to deal with in their own lines of business. And so for that reason alone, this type of transaction can become unpopular with many customers who perhaps don't want to take on the technicalities of being a public utility from FERC's perspective. Next slide, please. Now, another more recent product that is, I think in our experience here at Stoel Rives, more popular with many customers is the use of a virtual PPA. And so in a virtual PPA, a customer and a developer will agree upon a fixed price for power, but the customer is not actually going to receive that power. Instead, this is a financial arrangement where the developer will sell the power into the market, and depending on where the market price is, either above or below that fixed price, either the customer or the developer will be paid money. So for example, if the developer and the customer chose a fixed price of $50 and the market price was $45, the customer would true up the developer to the $50, because the customer is in effect guaranteeing that the developer will receive a minimum price for power. But the opposite's true as well. If the price in the market is above the fixed price, then the customer should receive a reimbursement of those excess revenues. Next slide, please. So considerations here is, again, this is a financial deal and not a physical one. For customers who want to actually physically receive title to renewable energy, this is not the type of arrangement that provides it. This is a financial bet in some ways, where a customer has the chance to offset its own retail power costs using the revenues associated with this fixed for floating analysis, or settlement, I should say. And these deals can work out, our customers, I should say, like to correlate to maximum extent possible the amount of revenues that they may receive in these virtual PPAs with the amount of power, the power cost they're paying for their businesses and locations by associating a virtual PPA in a specific market where that customer also has its own business locations. For example, if I have a data center in Virginia, then perhaps it's best for me to try and structure a virtual PPA for a project located in the same market as my data center, because it may more closely correlate the revenues associated in the wholesale market with what I'm paying and trying to offset with my retail power prices. Next slide, please. And then lastly, and this is perhaps the most direct way of being involved in the market, is customers will either install projects on site behind the meter, or a third party will own a project that's located behind the meter and sell renewable energy directly to a customer. And in that circumstance, a customer still maintains a relationship with its local utility, because to the extent that a solar facility or wind facility that's quote behind the meter is not producing, the customer still requires a relationship with the utility to lean on them for power in those down hours. Next slide, please. So some legal considerations here is, if you're using a PPA for some of these transactions, that power purchase agreement from the developer to the customer is a retail sale, and that's because the customer is consuming the power on site and not reselling it. And there can be restrictions in state law that prevent a party from selling power at retail, and that's because states have put in place franchised utility service territories, and those utilities have the right and the only right to sell retail power in certain geographic locations. And so this is a very state and resource specific type of arrangement that customers and developers can utilize. But it's important to look closely at the details depending on where you are and what you are trying to do. Okay, next slide. I guess this is just my my contact information for later if anyone does have any questions. But with that, I will turn it over to Barrett Stambler at AVANGRID to take us through some commercial considerations.
Thank you, Jason. I'm the vice president, and my job is really on a commercial side, which is provide renewable energy solutions to corporate customers. And next slide. Just to give you a sense, AVANGRID Renewables has been around really since 2000, but we've had several different names as we've had mergers and acquisitions, etc. For a while, we were PPM Energy, then we were Iberdrola Renewables, and now we are AVANGRID Renewables. This is a map of our assets that we currently own and operate around the U.S. And as you can see, we're in quite a few states, which is important when we're trying to meet all of the needs of various customers in terms of where they may be located or what structure you want. And we are used to dealing, as Jason pointed out, with the myriad of different structures that our commercial industrial customers deal with, because it really does vary from state to state and region, and we are pretty much involved in every state and region. And we have a pipeline of new renewables, wind and solar, of 6.5 gigawatts that we are currently trying to develop. Next slide. Again, I'm not going to spend too much time. Just that middle bullet is that we have done a number of transactions and actually many of which follow different structures that Jason just put forward. We have 5 different PPAs with commercial industrial customers for a total of 622 megawatts. We have a number that are at the final stages and will be announced in the near future. So one of the things that is just to point out about AVANGRID Renewables is that we provide custom solutions, and what differentiates us from many of our developer competitors is that we have a full energy management desk, and that allows us to provide direct access services in some locations and allows us to move power around the system, which is important when you're looking at some of these structures. AVANGRID, our parent, is traded on the New York Stock Exchange under AGR, but we are 81.5% owned by Iberdrola, which is one of the largest utilities in the UK, Spain, and the US. Next slide. So I have been doing this for a long time. I've been in the independent power business for many years. And I would say, sounds like a sales pitch, but I can't imagine a better time for purchasing renewables. The technologies, both in solar and wind, have made tremendous strides. And now, as I like to say, in many locations, you can have your cake and eat it too. You can have a good environmental or carbon reduction strategy, as well as compelling economics. What is kind of on the horizon that is driving a lot of demand right now is the tax incentives for both wind and solar are going to be phasing down. For wind, it's if you have not what is called safe harbor turbines, which you had to do by the end of 2016, and that meant that under the laws, you had to buy turbines at least 5% of the overall cost of a project has to be spent before the end of 2016 to effectively be able to build a project by the end of 2020, COD, and obtain full tax benefits. After that, it drops from 80% to 60%. Solar has a phase down, but that is happening later after 2020. I think the phase down starts in 2021. But we are seeing a lot of demand from commercial industrial customers that want to provide sustainability or carbon reduction to their employees and their customers. Next slide. So what I'm trying to do is, again, I don't want to repeat what Jason said, but I'm going to take this from a supplier perspective. As you can see, Jason talked about all of these options: direct load service, virtual PPA. But what I'm going to do is that as a purchaser of renewables, you can buy all of these, but there are different nuances depending on what the project, if the project is a brand new build or an existing merchant project, that will dictate some issues on the commercial side. So next slide. So the one consideration that we often talk to our customers about is kind of this, what we call green continuum. The idea that we have yet to talk to a potential customer in the C&I space who is not trying to achieve sustainability goals. And that means you need to clearly consider what story or what goals are you trying to achieve. And as Jason touched on, there are a number of considerations when you're looking at this from kind of a quote-unquote sustainability. Now, the good news is there are lots of options, and in my view, whatever option you take can be good as long as it meets what you are trying to achieve. But if you look at this as kind of, as Jason alluded to, if you are buying RECs, for example, you can buy two types of RECs. You can buy kind of a national REC, which is going to be the cheapest REC, because there's a whole series of RECs around the country, all different technologies that can provide that REC, and quite frankly, the cost of those are much lower. At the same time, some people want to buy a REC that is at least located near their facilities, and that would be a regionally supplied REC, which likely, not necessarily, likely is going to be more expensive. Again, it depends on the region. If you're, let's say, in Texas, you're probably going to pay some slight premium, but because there are so many projects, existing renewable projects in Texas, there is not much of a premium. They're very close to national RECs. But if you were buying in California, where there's still an RPS that is still trying to be met going forward, you're going to pay a significant premium. So those are some of the considerations you need to think about. Option two is, as Jason said, virtual PPA. And that means that you are not necessarily, it's a financially settled product. And I will get into some additional benefits from that. But when you say virtual PPA, there are a number of ways you can meet that need. We have projects that we call merchant that already exist. And as a result, we don't have to build a new project, and your commercial requirements are going to be less in terms of term and some other things like that. But you also can do a virtual project with a brand new build project, which, as you can imagine, we would be building that project on the back, so to speak, of the purchase. And that would mean we would need to make that large investment. We would need to make sure that the contract supports that long-term investment. And then there's a new category called repower. And again, I will go into more detail, but we have a number of facilities that are 10 to 15 years old. They have already received their tax benefits. And believe it or not, the technologies have changed so dramatically that you can, at a reasonably low cost, repower without kind of ripping down the whole turbine. You can kind of leave the tower and the foundations and retrofit the turbine itself with new technology and increase output. But it is not 100% brand new. You'll get incremental generation. And then the last one is direct load service, which we, again, all of these types of products we have provided to various customers who are trying to achieve different goals. Direct load service, as Jason said, is very, the devil in the details on where you're located and what the law allows. We do, for example, provide these type of services in Oregon and Washington, where a large buyer can choose to buy their power directly from what is called an energy service supplier, which is an alternative generator to the utility. As this says, this is kind of the gold standard, but again, the gold standard would depend whether you're buying new, existing, or repowered, and all of that would go into the story. Next slide. So Jen, just going through these a little bit more, if you do direct load service, we think it's the greenest claim possible, because one of the goals is to actually serve your load directly with renewable energy. Under that, and it's a physical delivery, so you can kind of show a direct linkage between the renewable energy. And you can do that with some combination of existing generation, renewables generation, or new generation or repowered generation. But as Jason said, contracting structure is more complicated. Now, I say physical delivery, I'm going to talk about some accounting issues that are important, but your accounting issues are minimal when you take physical delivery, which seems like not a big deal. And I'm not an accountant, and I don't play one on TV, but it has become a very big issue in a lot of our negotiations. And of course, direct access needs to be available in the region. Next slide. Virtual PPA, new project. So, you know, what typically happens depending on how large the customer is, a lot of entities that have loads spread out around the country are kind of saying, well, I'm not going to get physical service in each of my locations. So why don't I aggregate all of that power and buy one big project in the best economics possible? So this tends to be in places like Texas or the Midwest, a lot of the transactions where the capacity factors are very high and the development costs are low. And, you know, that has appeal. Obviously, everybody cares about economics. The other thing is if you're buying a new project, very important for a lot of commercial industrial customers is that they can make an additionality claim, which means that they can say by them purchasing the power out of a project, they are making a new renewable facility built. And although there's some trade-offs to that issue, which maybe I'll deal with in the Q&A given time, that is become a very important component for buyers. And obviously low prices and have been available by aggregating and doing a virtual PPA, because arguably you just put the project in the most liquid area with the best economics. But there are some potential accounting issues. The two big ones are, the biggest one is mark to market, which means that, and there are ways to structure around this. Certainly you have to know whether you're US GAAP or IFRS. If you're US GAAP, then there's definitely a way to structure around it. If you're IFRS, it becomes more difficult. The challenge around mark to market is that basically you're going to may have to mark your earnings compared to the market on a quarterly basis, which means that this is going to show up at some volatility to your earnings. And the reason why people care about that is because, first of all, most of the commercial industrial customers are not, they're not in this business, they're not energy experts. They're not, and they want to do these things but they don't want to have to they want to talk about the good parts of it, but they don't want to have to deal with the accounting issues. But again, you can deal with that, but financially settled. And then lease is you're concerned about something showing up on your balance sheet, debt in particular, that most entities want to avoid. And there are ways to structure around that. I won't get into all the details. But I would, when you get to that point, obviously everyone's accountants have their perspective on this. Next slide. I talked about a repower. I really think this is an interesting option because a lot of these, what I consider from just a good environmental, you're not increasing, so to speak, the footprint of your generation. You're efficiently improving it. I think there's arguments around the additionality claim, certainly the extra generation. Very little development risk because you're not permitting a whole new project. The cons is it's not fully a new project. Next slide. Now, this is one that I think power purchase from an existing merchant renewable project can be a virtual PPA. It can be a physical PPA. It can be a direct load, but the key here is that we have invested in projects over the years. And some of our projects are old enough that the power purchase agreement has expired that we were selling under, or we built some projects with the idea that the market was going to improve. Not necessarily a great, the market didn't play out that way, but we do have a lot of generation that we are still open. The good part about it is very flexible contract terms because you've already built your project. You can do much shorter than 10 years, whereas if you're building a new project, you really need somewhere in the 10 to 15 years. At least that's common perspective. It's already operating, so you can bring it on. You can do the deal quickly. There's no development risk. The downside has been no additionality claim. And then in some ways you're going to get, if we're already producing, we're going to price it based on the current market price, which can be good or bad depending on how low cost someone could build a new project there. One thing just to pitch, I think that merchant, a lot of folks took some risk on early projects, and the fact that people may not want to buy from that does not necessarily encourage developers to take risks about building more generation without a buyer, which I think is not necessarily great for the total penetration of renewable energy. Next slide. As we talked about utility green tariff, we are also working with the devil's in the details of how this green tariff is set up. We like the utility green tariff, but we think it needs to be structured in a way that gives customers the most options at the lowest cost. So this means that you're kind of filtering your purchases. If you're a developer, I'm selling to the utility who is then selling to you. We are working with a party that I think the tariff is allowing us to kind of structure products that really meet the specific customer's needs. And that could be building new projects, selling existing projects. But the big benefit is that the utility provides the integration service into your load, which you don't have to go out and do independently. As I said, the tariff can be restrictive, and sometimes, depending on how sometimes these tariffs say, I'm not going to buy more than X megawatt hours. They have been restrictive or have been experimental in nature, which has effectively not made them work for potential customers. So again, the structure of the tariff is what's important. Next slide. Not much. I think, again, this was covered by Jason pretty well. Next slide. And that was a quick run through of this is my contact information. We do provide customized solutions of all of these structures to our customers and understand the rules and regulations around them and the trade-offs. So I look forward to, it's really an exciting time when large C&I customers and small C&I customers have options and at economic prices to build renewables. So that's it for me. And we are now open to questions. So we are happy for the next, I guess, 10, 15 minutes to answer your questions as you see fit. Thank you very much.
Thank you so much. Thank you, Jason and Barrett, for your presentations today. Now I'll take a look. Don't forget to ask questions in the Q&A box in the lower right-hand corner of your screen. I see a few questions here, so let's dive right in. Okay, Dana asks, has there been an acceptable resolution of the mark-to-market and release ownership issues that commonly plague the original generation of virtual PPAs? And what are the structural mitigations, if any, that can be used to alleviate the market-to-market and lease concerns?
I don't know, Jason. I will jump in. I'm going to repeat that there are some mitigations. I am not an accountant. Lease issues. I'm looking for my cheat sheet here. So for mark to market, even if you have a virtual PPA, and again, I have gone through this enough that different accounting agencies, even the big four or whatever, have a little different perspective on all of this. So you have to kind of look at the specific situations. If you're under US GAAP and you're doing, you want to do a financially settled PPA, the way to get around having mark to market is, as long as you don't have minimum output guarantees, that typically allows you. So most customers want some level of performance guarantee. There are kind of two major categories. There's an output guarantee and there's an availability guarantee. It's general viewed that the availability guarantee, which is basically protecting you against the breakdown of the technology itself, as opposed to guaranteeing the wind resource, which, by the way, can be challenging to guarantee, but can be done at minimum levels. But if you go for an availability, and a lot of our customers who we've done transactions with have been fine going with an availability by making sure the technology performs as expected, but they use outside meteorology consultants to make sure that if the turbines can perform as expected, then they will get the meteorologists will say you're going to get a certain resource, then they get comfortable with that. For IFRS entities, which some people both have, we're under US GAAP, AVANGRID, but we also have we're also go up to a international, so we are under both. We can avoid, it's harder under the IFRS to avoid mark to market under financially settled contracts. But under US GAAP, definitely can be done. In terms of leases, if the buyer is taking 100% of the output and the price is other than fixed or market-based per unit of output, the agreement is most likely a lease. So in this case, you can do a couple of things. You can buy a piece of a larger project, less than 100%, or you can enter into a fixed price PPA. And fixed price, if you have one number, the safest thing is one number for the term of the contract, then you would avoid a lease structure. Again, there are other ways to get around these. These are kind of very high level, and if people want to hear more detail, I've got a guy, among other things, thinks about these issues. I'm happy to bring an expert into play here to help you get a little more detail than me. Okay? That's my answer.
Barrett may not be an accountant, but he does play one on webinars. Good job. Good answers.
That was great. Thank you, Barrett. Okay, so we actually have another question from Robert, and it's again with virtual PPAs. Why is a virtual PPA more advantageous than purchasing certified unbundled RECs? Seems like you end up with a similar product without taking on a long-term contract or energy market price risks.
Barrett, I'm happy to jump in, but I'm sure you have a perspective on this.
You jump in. I spent a long time on the accounting issue.
Well, I think Barrett actually summed up perhaps the answer to this in his portion of the presentation when he said that it really depends on what you want as a customer, what your goals are. So purchasing unbundled RECs can certainly be used as an offset to your demand. It's easily applied demand at different locations or a collection of locations across a corporate family. But if, as a corporation, if you have the goal to invest in or create additionality, perhaps, then you need, I think, to take or I guess have a closer relationship with a renewable energy facility such that you can actually help it become financed. I think Barrett may have a different perspective on this, or maybe you share my perspective, but it's awfully tough to, I think, finance a facility in the market on a purely merchant basis. At least a virtual PPA would provide a floor to that facility and some basis for financing. So a corporation that really wants to see a facility be built, add to the renewable energy facility fleet of this nation may consider a closer relationship like a virtual PPA.
And I would just agree. I mean, I think you captured it. I mean, again, as this part of the procurement area has progressed, you know, a lot of people did start with unbundled recs, and it's not a bad place to, and you know, I shouldn't say not a bad place. I'm saying it's a fine place to go. You know, these can be complicated, and you're right. I mean, a virtual PPA can have more challenges, certainly. But I think what you're seeing is there are a lot of kind of outside groups that are kind of trying to, and it's not necessarily the supplier, outside groups that are trying to urge or direct or rate customers on how they're contributing to the renewable energy growth in the U.S. And there tends to be, these groups tend to want you know, they kind of put a better green stamp of approval on transactions that make new projects built. One of the challenges, and there's probably a range of people on this phone that have various levels of procurement needs. The nice thing about a renewable rec procurement is it's pretty usable if you have a very small footprint and you want to just do something. I think that if you have a small footprint, what a lot of people would want is you to look at kind of, which we don't do, but look at these distributed generation, put something on your manufacturing facility or something like that. But again, it's all about the story. Believe it or not, it's all about the story you want to tell and what you're trying to achieve. And certainly RECs is, we have a lot of projects, and selling RECs is an important part of our revenue stream. We sell millions of dollars in RECs every year because we have projects that are merchant and have RECs. So again, it's just trying to show you the continuum of options that you have. But if you're smaller, you might want to go towards one of those structures that allows you to kind of aggregate with other parties. And that's an area that the development industry needs to deal with, because there are a lot of customers with smaller loads but want to buy help support a new project but don't have the option. So that community renewables or even aggregation of a number of players with a standard contract are something that we're all trying to look at from the development perspective.
Great, thank you both for your answers. We have one last question here from Kimberly, and she just wants to know if you could please explain the concept of additionality to her.
Well, I mean, additionality just means that you are doing something that helps create an additional improvement to the environment or reduction of carbon. And so just what additionality has, and there's probably some technical terms, but additionality has grown to mean that by your action as a buyer, you have created the additional construction of a new renewable facility or more renewables being built. So they call it, for whatever reason, unless Jason has a more technical understanding, that's called additionality. So if you were buying from an existing facility, that would not be called additionality, because that facility, whether you buy or not, is going to continue to produce and put out the same amount of carbon reduction or renewable credits. The only thing I would say is that's not necessarily true as these plants grow older. So I'm putting in a plug because I think merchant has gotten somewhat of a bad name. As these plants get older, if the value you're getting for these plants from a revenue perspective are not sufficient, you actually may see some of these plants getting shut down. And I think that would create a negative impact in terms of additionality. So, but typically that's how I think most folks think about additionality.
All right, great.
I think they summed it up.
I'm sorry? I didn't catch that.
Sorry.
All right. So
I think Barrett summed it up well.
I'm sorry, I can't hear you. Hi. Okay.
Jason said I summed it up well. Jason said I summed it up.
Pardon me. Sorry.
I think.
I believe
Thank
him.
you,
All
Jason.
right. Thank you so much, Jason. Sorry I couldn't hear you there. But thank you guys for the Q&A. Really appreciate it. I just want to say thank you for joining our webinar. Everyone who is here today, you will receive an email with a recording of this webinar within 24 hours. So if you want to listen to it again, feel free to do that later on. And this is an InfoCast webinar. If you're interested, we have some more webinars coming up. So please visit infocastinc.com to check those out. And lastly, just want to say thank you so much to Jason and Barrett for their presentations today, and everyone who tuned in. Hope you guys have a great day, and we'll see you guys next time.